Hey everybody, it's Mark Johnson here with a Cross Country Mortgage, and I am grateful to be with you this afternoon. It's a little bit late. Well, it's not quite this afternoon yet. Feels a little bit later than usual, but it's great to be with you here. I wanted to just take a few minutes and explain what's going on with interest rates. Interest rates again this week are up a little bit over last week. It's been a volatile week because of so many numbers that are coming out and the fear over inflation. And our biggest fears happened today. Today we got the inflation numbers, and it was higher than expected. Because of that, because of inflation, we feel like we got to peek at the federal minutes that came out yesterday from last week's Fed meeting. And basically, they are very hawkish. They feel like they would rather raise rates higher than need be rather than come in below. And so we're going to see still a lot of more pain, probably for another 3 or 4 months. And what they'll probably do is in the next meeting, which is November 2nd, they'll probably raise rates again another 0.75%. And that reason is because, and I'm going to go through the numbers here in just a minute, inflation still is pesky high, and you've got unemployment just really, really low. So let's just go take a look at some of the numbers here. So today, after the inflation news came out, it was just a horrible day with interest rates. And over the last week, it went from 6.7 something or other to 6.92. So you're going to see interest rates by most lenders higher than they were last week. We have been telling everybody lock. Every time you get a contract, lock as quickly as possible, because tomorrow the rates are going to be higher. And that's been the case for the last 7 days for sure. So with that being said here, let's take a look at the inflation numbers here. If you notice back a year ago that they're comparing the rates today, inflation was only 3 to 2% here. Whereas, we had July, which was really low, but then we've got 6% here month over month, or in September it came out at 8.3. Well, let's just take a look at it here. So when we're comparing these numbers to last year, you're going to see obviously that inflation is a lot higher. The cost increases in shelter, food, and medical care were the largest contributors to the higher inflation uptick that we saw, according to the Labor Department. While these costs are pretty, partially offset by a 4.9% decline in gas prices, energy prices overall fell 2.1% for the first time in a long time. And so along with gas and gasoline, and then natural gas and electricity cost increases, the year-over-year energy prices rose 19.8%. And then food was up 11.2%. By the way, did you know that food consists of 14% of the inflation index? That's crazy. So the Federal Reserve is going to continue to aggressively hike rates as we see them right now. Let's look at what happened this morning. So when rates first came out because of the CPI number, we saw that the 10-year treasuries were up by 16 basis points, and the mortgage bonds were down 134 points. It was just kind of a knee jerk reaction. Things have gotten a little bit better since then. And so just a few minutes ago, our rates, were only down 19%. So you can see that it's recovered. And there's a really strong floor of support here for interest rates. And then bond prices are pretty much, flat through the day. So they were up 4.06% or 07%. Actually, the high was 4.071. I can't see that. It's pretty small printing. But anyway, things have recovered quite a bit. But nonetheless, we're going to still see some rates increases over the next couple months. Unemployment still are really, really low, but there's some signs that unemployment may raise in the next few months as companies have held off on, laying off really good people. I think they've trimmed all the fat, in other words, the people that are not producing or not good workers. And, and we've seen first-time home unemployment numbers go up by 9,000 jobs. So there's 9,000 people that are filing for unemployment for the first time in a long time. So guess what I'm saying here is that we're still going to be in an upward trajectory, I think, for interest rates for maybe another month, maybe through the middle of November, first part of December. We might start to see interest rates start to come down sometime then. Again, Fannie Mae, and I just want to just go through this again. They have not come off of their stance that they still feel like interest rates will be 4.5% by March of next year. Rates could come down quickly. Rates have gone up quickly. We saw that. I personally think rates won't come down until, maybe June or July. But nonetheless, today is a great time to buy a home. And one of the reasons I'm going to give you is this. We saw that apartment rents have gone up significantly too over the last, year or two. And when you've got apartment rents going up 7 to 10% every single month, that's a lot, right? Year over year, 10%. So in other words, if you were renting and it was costing you, $1,500 a month this year, it's going to cost you $1,660 next year. Whereas if you get a fixed rate mortgage right now, your payments will stay the same. It won't be going up. Now, the other thing too to remember is the 3-2-1 or the 2-1 or the 1-0 buy downs. That is called an inflation buster type loan, where we can start your payments 1 to 2, even 3% below what the current rate is. So if you're looking at 7%, you do a 3-2-1 buy down. You can start at 4% for 1 year. Then you can go to 5% to 6% to 7%. But in the 44 years that I've been doing this, I can tell you that you will not get to that third year or even probably the second year. I think within 12 months, you'll be able to refinance and have a lower monthly payment. Anyway, I hope this was helpful. Have a great day. If you have any questions, DM me or shoot me an email. I'd love to chat with you. Thanks.